Price dips first. But the lower side does not open. The long begins at the edge. May 19th Asia session basis box forms almost directly on top of the May 19th US session box. That matters immediately. The market is not starting from fresh space. It is starting from overlap. It is starting from repeated memory. When one session forms almost identical to another session box, the market is telling you that price is not free yet. It is trapped inside a known area. That can reduce clean breakout quality. But it also makes the edges more useful. The lower edge matters more. The upper edge matters more. The midpoint matters more. You are not looking for a random candle. You are looking for where memory fails or holds. May 19th Asia session first drops. It tests the lower boundary of the May 19th US session box. That is the first important moment. If the lower boundary breaks and stays broken, then the whole long idea weakens. If it only tests and returns, then that lower side becomes usable support. The difference is not the touch. The difference is whether price can stay there. That is always the pressure point. Price pushes lower. It reaches the lower boundary, but it does not keep building distance below it. The downside pressure cannot expand. Bodies do not continue cleanly. The move stalls. That is the first clue. Then price turns up. Now the behavior changes. Price rises through the session. It breaks above the upper boundary of the May 19th Asia session basis box. That matters because the market is no longer just bouncing inside noise. It is now reclaiming its own session structure. Then price keeps pressing and reaches the upper boundary of the May 18th US session box. That becomes the next memory test. So the move is clear. Test the lower side. Hold. Reclaim the local box. Push into prior US memory. Now the trade logic. Long entry line. May 19th Asia session basis box lower boundary. That is the line. Not because it feels cheap. Not because the candle is green after it. Because that is where the session proves whether the lower side can hold. When a session forms almost fully overlapped with prior US memory and price drops into the lower edge without opening fresh downside space, the lower boundary becomes the decision line. If that line holds, you have a structure-based long. If that line fails, the trade idea is wrong. That is why the entry belongs there. You are not chasing the breakout at the top. You are not buying the first green excitement. You are entering where the structure lets you define risk. That is the whole method. Entry is not about feeling early. Entry is about knowing exactly where the trade should not fail. Now the stop. Stop loss line. April 21st US session box upper boundary. That is a deeper stop than an aggressive trader may want. But it is the more stable line. Why does it belong there? Because below the May 19th Asia lower boundary, the market still has room to shake. This session is forming on top of repeated memory. The lower side can be tested more than once. If you place the stop too close, the market can tap it and still perform the original long. Then the stop was not protecting the idea. It was only protecting emotion. The April 21st US upper boundary is the more meaningful invalidation line because if price falls that far, it is no longer just retesting the local overlap. It is losing older support memory underneath. At that point, the entire reclaim logic is damaged. So that is where the trade is wrong. Not uncomfortable. Wrong. That distinction matters. Aggressive traders may tighten the stop. They may reduce the stop distance and raise size. That can work when reactions are sharp and immediate. Sometimes price never comes back for that deeper test. But the risk is simple. A tighter stop can lose the position before the structure finishes working. A conservative trader does the opposite. The stop goes deeper. Position size gets smaller. The idea is to survive the natural shake inside overlapping memory. That does not make the trader weak. That makes the trader consistent. You are not trying to win one candle. You are trying to stay inside the valid structure long enough to get paid. Now the first target. Take profit line. May 19th Asia session basis box upper boundary. Why there? Because the first job of the long is not to conquer the world. The first job is to complete the rotation from the lower edge to the upper edge of its own session structure. That is the cleanest first objective. When a long begins at the lower boundary of an overlapped box, the first target should usually be the opposite side of that same box unless price shows earlier signs of failure. This gives the trade symmetry. This gives the trade a natural range objective. And this is important. A target should not be chosen only because the number looks large enough. It should belong to the structure. That upper boundary belongs to the structure. Once price reaches that first target, the trade has already worked. Now the trailing decision becomes possible. Trailing target. May 18th U.S. session box upper boundary. Risk-reward ratio. 2.72. That second objective is not random either. Once price reclaims the top of the May 19th Asia box, it is entering the next layer of memory above. The May 18th U.S. upper boundary is the next place where older sellers may react. So if price reaches the first target and still holds distance, the trade can stay alive into that next memory, but only if price earns it. That is the key phrase. Price must earn the trail. You do not trail because you want more. You trail because price has already shown the ability to hold above the first objective. If price reaches the upper boundary and immediately collapses back inside the box, then the trail has not been earned. If price holds above, or reacts shallowly and continues, then the extension is valid. Now the trailing rule. When the target moves, the stop must move too. A new target with an old stop is not trade management. It is wishful thinking. But the stop cannot become too tight. If you drag the stop too close behind the last candle, small noise can hit it. Then the trail cuts profit instead of protecting it. That is why trailing distance matters. A useful rule is simple. The interval between trailing decisions should usually be at least half of the original risk-reward unit. That keeps the trail meaningful, not nervous. Also remember one more condition. If the adjusted stop still cannot move beyond the entry without becoming structurally weak, then sometimes trailing is not worth it. In that case, taking profit without trailing can be the better decision, because the market has not created enough excess distance to justify a second stage. Now think about partial profit. A conservative trader may take 60% at the first target and leave 40% for the trail. That works when the first range objective is already a good payout, and the trader wants to protect the session's main win. An aggressive trader may do the opposite. 40% first, 60% left open. That only makes sense if price keeps distance and the reaction stays shallow. If a move becomes a larger two-stage extension over time, then a conservative approach can use 50%, then 30%, then 20%. A balanced trader can use 25%, then 50%, then 25%. An aggressive trader can use 20%, then 30%, then 50%. But the percentages matter less than the structure. If the market starts shrinking bodies and printing faster rejection near the first target, protect more. If it keeps lifting and holding above reclaimed levels, let more remain. Now step back and read the whole move. May 19th Asia forms almost directly on top of May 19th US memory. Price drops into the lower boundary of that memory. The downside cannot expand. Support holds. Price turns. It breaks the Asia upper boundary. Then it reaches the May 18th US upper boundary. The long begins at the lower edge, because that is where failure can be defined. The stop sits at the April 21st US upper boundary, because that is where the reclaim idea truly breaks. The first target sits at the Asia upper boundary because the first job is to complete the box rotation. The trail reaches the May 18th US upper boundary because that is the next memory above. Risk-reward ratio, 2.72. One more point matters. Because the May 19th Asia box is almost identical to the prior US box, no trade is also a valid decision. That overlap can keep price trapped. It can keep reaction small. It can make the session slow. So if the lower side does not show a clean hold, stepping aside is not a missed opportunity. It is discipline. The long only becomes clean after the lower side refuses to open. That is the edge. That is the execution. Price stays inside memory, but the lower side keeps paying. The long begins again from support. May 20th U.S. session basis box forms almost directly on top of the May 18th U.S. session box. That overlap matters at once. Again, the market is not opening into fresh space. It is reusing a known area. That can frustrate traders who want explosive, clean trend. But for a structured trader, that kind of repetition is useful. It tells you where the boundaries matter. It tells you where the long must hold. It tells you where the move becomes invalid. Price continues inside the May 20th U.S. session box. It does not immediately break out. It rotates first. That is important. Because when a session forms almost identical to older memory, the market often needs to prove itself through repeated tests before distance appears. You see the slow movement. You see the box holding price. You feel the temptation to chase the first small push. That is where bad entries begin. Not here. The correct approach is still the same. Wait for the edge. Let the structure speak. Then, price pushes higher. It reaches toward the lower boundary of the April 27th U.S. session box. That is older memory above. So the session is doing two things at once. It is holding the new overlapped box from below, and it is climbing into prior resistance from above. Now the trade logic. Long entry line. May 20th U.S. session basis box lower boundary. That is the entry. Why there? Because the session is forming almost on top of the May 18th U.S. box, so the lower edge of the current box becomes the clearest decision line for buyers. If price sits above that line, rotates, and then responds upward, the market is telling you the lower edge is being defended. That is a cleaner long than buying in the middle of the box. A midpoint entry often leaves you with weaker reward and less clarity. A lower boundary entry gives you both. It gives you price advantage, and it gives you a clear place where the trade should fail if it is wrong. That is why the long belongs at the lower boundary, not at the top after the move is already obvious. Not in the middle where risk and reward both become blurry. Now the stop. Stop loss line. May 19th U.S. session box, lower boundary. This stop sits beneath the local support cluster. That matters because the May 20th session is leaning on the strength of the recent overlapping structure. If price falls through the May 20th lower boundary, there is still one more question. Can the previous session memory beneath it hold? The May 19th U.S. lower boundary answers that question. If price loses both the current lower boundary and that prior lower boundary, then the support stack has failed. The long no longer has clean ground underneath it. The overlap that helped the trade now turns against it. So the stop belongs there. Aggressive traders may again choose a tighter stop, perhaps under the current session only. That can improve the ratio. But it also increases the chance of being removed by ordinary rotation. A conservative trader accepts the deeper stop and cuts size. That gives the trade more room to survive the repeated testing that often happens inside these overlapping session boxes. The choice depends on the trader. But the principle does not change. The stop must sit where the structural reason for the trade ends. Now the first target. Take profit line. May 20th U.S. session basis box upper boundary. That is the natural first objective. Why? Because the move begins from the lower edge of the current box. The first clean job is to complete that rotation from low to high. Until that happens, the trade has not yet finished the most basic work. You do not skip the local objective and start dreaming about the bigger breakout immediately. You let the market finish one task first. That is what keeps the method calm. That is what keeps you from over-projecting. Once price reaches that top side, the long has proven the box rotation. Only after that does the next question appear. Can the move extend into older memory above? That is where the trail comes in. Trailing target. The lower boundary of the April 27th U.S. session box. Risk-reward ratio, 2.23. That upper memory is not chosen because it is simply farther away. It is chosen because it is the next structural ceiling that price is already reaching toward. The current session rises until it tests that April 27th lower boundary. That means the trail is not fantasy. It is grounded in the chart. But the same rule applies again. The trail must be earned. If price only pokes the top of the current box and immediately falls back, the long has done its first job but not enough for a higher objective. If price reaches the upper boundary, holds its gain, and continues pressing, then the trail becomes valid. That is how execution stays honest. Now think about the behavior inside the box. The session continues within its own structure for a long stretch. That can make traders impatient. They see small up candles. They see small down candles. They enter too early, or they give up too soon. But overlapping session memory often behaves like that. It rotates until one side proves stronger. The correct response is not impatience. It is selection. Wait for the lower edge to hold. Wait for the return from the lower side. Then let the range complete. That is why this long is cleaner from the lower boundary than from any other place. Now the stop and target movement. Once price reaches the first target, the stop must follow. Again, the stop cannot stay too far away. The trade has already earned distance. Profit must be protected. But the stop also cannot be dragged so tightly that one normal pullback erases the second stage. The trailing gap should still respect the rhythm of the session. A useful guide remains the same. Do not trail with tiny nervous adjustments. Let each adjustment represent at least about half a unit of original risk-reward. That makes the trail structural rather than emotional. If the market has not created enough room to move the stop meaningfully, then extending the target may not be worth it. That is an important lesson. Not every valid trade deserves a big extension. Some only deserve the first target. Others deserve one more layer. The chart decides, not desire. Now, think about profit distribution. A conservative trader may take 60% at the top of the current box and leave 40% for the trail into the April 27th lower boundary. An aggressive trader may leave 60% open if price keeps lifting cleanly and the pullbacks remain shallow. If later extensions create more layers, then scaling choices can expand into 3 steps. A conservative trader may take 50, then 30, then 20. A balanced trader may use 25, 50, 25. An aggressive trader may use 20, 30, 50. But only if structure continues to open upward. If price slows near the first target, shrink the ambition. If price keeps accepting higher levels, allow the trail. Now read the session from beginning to end. May 20th U.S. forms almost directly on top of May 18th U.S. memory. Price rotates within the current box. The lower side holds. That makes the lower boundary the usable long entry. The stop sits under the May 19th U.S. lower boundary because losing both support layers would break the long idea. The first target is the May 20th U.S. upper boundary because the first job is to complete the session rotation. Then, if price holds and presses higher, the trail reaches the lower boundary of the April 27th U.S. session box. Risk-reward ratio, 2.23. The session teaches something larger too. Repeated overlap does not always mean weakness. Sometimes it means the market is building a platform. But you only know that after the lower edge survives testing. That is why patience matters. That is why entry location matters. That is why buying the middle of the box is usually weaker than buying the defended edge. And that is why structure can turn a slow session into a clear trade. The market does not need to look dramatic. It only needs to behave correctly. Lower boundary holds. Rotation completes. Old memory gets tested. That is enough. That is the trade. That is the execution.